The full new state pension is $12,480 a year. The personal allowance, the amount you can earn before HMRC takes anything at all, is $12,470. Those two numbers sit so close together they're almost touching. And the moment your pension drawdown, your savings interest, or your investment income lands on top of that state pension, HMRC collects on every extra pound, not in a dramatic way, just quietly, automatically at 20 pence in the pound to begin with, then 40. No letter, no warning, it just happens. I spent nearly 4 decades in UK tax, personal returns, pension cases, inheritance planning, SIP work. Since I retired from practice, I've been sitting with people at PensionWise and Citizens Advice. People who worked hard, saved carefully, and did everything right. And I kept watching the same thing happen. The same 5 financial positions, all completely legal, all perfectly fixable, costing them money they didn't need to spend, because nobody had explained it before they stopped work. That's what this video is. 5 things about where your money is sitting right now that become significantly more expensive to deal with, or in some cases, completely impossible once you stop earning. Not lifestyle advice, not vague suggestions about spending less. 5 specific structural positions, and the window to sort them is open right now while you're still working, in ways it simply won't be later. One of them involves a change coming in April 2027 that most people approaching retirement haven't fully taken in yet. By the time they do, it may be too late to do very much about it. If you own actively managed investment funds outside an ISA in a general investment account, sometimes called a GIA, there is a good chance they are costing you tax every single year without you noticing. Not when you sell, just by sitting there. Here is what happens. The fund manager inside your investment is buying and selling constantly. That is what they do. Every time they sell a winning position, it creates a taxable event. Some of that feeds through to you as income. Some comes as a capital gain. At the end of the year, you get a statement, perhaps a tax certificate, and somewhere inside it is a number that HMRC expects you to account for. You did not make a decision. You did not choose to sell anything. The manager did, and the bill arrives with your name on it. Layer on top of that the dividend allowance, which is now just $500 a year, £500. It was $2,000 as recently as 2018. If you hold income-generating funds outside your ISA and they produce, say, $3,000 in dividends this year, more than $2,500 of that is taxable. As a basic rate taxpayer, that costs you around $219 tooling. As a higher rate taxpayer, closer to $844. Year after year, on income, you may barely notice landing in the account. The fix is to move these funds into your ISA, replacing actively managed funds with tax-efficient index trackers in the process. The annual ISA allowance is $20,000, money that can sit inside the wrapper permanently growing and paying income, entirely free of income tax and capital gains tax. Not deferred, free. And the right time to do it is now, while you are still earning. Because while you are working, you have money coming in each month to fund those contributions. Once you stop, the only way to get money into an ISA is to sell something taxable first, which may itself trigger the very CGT problem we are about to come to. One honest point. Check the ongoing charges figure on any fund you are considering, not just the headline rate. Costs vary considerably between fund types, and over a long retirement, even 0.5% a year in charges matters more than most people expect. Now, the second thing, and this one involves a window that is genuinely closing. The capital gains tax annual exempt amount, the amount of profit you can make on shares or investments before CGT begins, is now $3,000 a year. $3,000. 4 years ago, it was $12,300. It was cut in stages, and it has not recovered. That means if you have held investments outside an ISA for 10 or 20 years, and they have grown, you now have a very narrow tax-free strip to work with each year when bringing those gains inside the shelter. The strategy is called a bed and ISA. You sell an investment held in your general account and immediately rebuy the same thing inside a stocks and shares ISA. The sale crystallizes whatever gain has built up. You pay any CGT due above the $3,000 allowance. But inside the ISA, every penny of future growth and income is permanently untaxed. You have moved the asset into a better home, a number to hold on to. A couple, both 60, both basic rate taxpayers, each hold an index tracker fund bought 15 years ago. They paid $18,000 each. It is now worth $52,000. Embedded gain, $34,000 per person. If they do nothing and sell both positions in retirement at 67, say with state pension and pension drawdown both running, the taxable gain on each is $31,000 after the $3,000 exempt amount. At the CGT rate for basic rate taxpayers, which is currently 18%, that is $5,380 per person, over $11,000 between the two of them in a single tax year, for moving money they already owned into a different account. If instead they start a bet and ISA now, selling a portion each year using the $3,000 exempt amount each time, spreading the gain across 5 or 6 years, the total CGT on those same positions could be close to nothing. Not through any loophole, simply through using an allowance they are entitled to in years when their income is low enough to make it work. A pattern that came up again and again in my career. Couples in their late 60s with substantial gains sitting outside the ISA, rapper who had saved diligently for 30 years and never once been told to use the annual CGT allowance, while the number was meaningful. The allowance does not carry forward. Every year it is not used, it is simply gone. The urgency is real. Once the state pension starts, currently $12,548 a year, it consumes almost the entire personal allowance of $12,570 immediately. Add any pension drawdown on top, and your income is already in the taxable zone before a single pound of capital gain appears. The rate might still be 18%, but the threshold for tipping into the higher rate of 24% gets closer faster than most people expect. The window to move gains at the lowest possible cost is while your income is low. And for most people watching this, that means either now or in the first years immediately after work ends. What comes next goes considerably deeper. And one of the 3 things still to come involves a rule change that in nearly 40 years in this work, I think is the most significant thing to happen to ordinary retirement planning in a generation. The third position is straightforward, so I will keep it brief. If you hold bonds, bond funds, or anything designed primarily to pay you a regular income, and those assets are sitting in a general investment account, every pound they produce is taxable income. The personal savings allowance gives you $1,000 of interest tax-free if you are a basic rate taxpayer, just $500 at the higher rate. Above those limits, HMRC takes its share at your marginal rate, the same rate as your salary. The same bond fund inside an ISA pays exactly the same income. The risk is identical. The return is identical. HMRC's involvement is 0. Before you stop working, while your ISA allowance can be funded from earnings, sort this. Sell the income-bearing positions in your general account. Check for any CGT implications first, and rebuy them inside the ISO wrapper. The annual allowance is $20,000. It does not carry forward. Every April that passes without using it is permanent shelter gone. The fourth thing is something I rarely heard discussed until I started doing pension-wise work, and the silence around it continues to bother me. Between the day you stop working and the day your state pension begins, your income is at its lowest point in adult life. No salary, no state pension yet. And in that gap, you can draw from your pension pot at the lowest income tax rate you will ever pay in retirement. Within your personal allowance of $12,700 a year, you can take money from your pension at no income tax at all. Here's what that looks like. A couple, both 63, both just retired. Each has an SIP pot of around $180,000. State pension is 4 years away. In each of those 4 gap years, each partner draws $25,000 from their pension. The first $12,570 is covered by the personal allowance, no tax. The remaining $12,430 is taxed at 20%, roughly $2,286 per person. Effective rate on the full $25,000 under 10%. Now the state pension starts. Currently $12,548 a year. It consumes almost the entire personal allowance from the first payment. That same $25,000 of drawdown now sits almost entirely in the taxable zone. Around $5,000 in income tax per person each year, more than double what they were paying in the gap. Over 4 gap years for 2 people, the difference between drawing in the gap and waiting until state pension stacks on top is somewhere around $20,000. Same pension, same retirement, different timing. 2 things to be clear about. Drawing earlier means your pot is lower earlier, and your own numbers need to work before you commit to this. A pension-wise appointment is free and government-backed, and it is exactly the right place to run through those numbers. And once you take flexible income from a defined contribution pension, something called the Money Purchase Annual Allowance applies. It reduces the amount you can contribute back into a pension to just $10,000 a year. If you are still working and still contributing, the sequence matters considerably. And now the 5th thing. The one that in my view represents the single most significant change to ordinary retirement planning in a generation, and the one most people approaching retirement have not yet properly absorbed since 2015, when pension freedom rules changed everything. A quiet but entirely rational strategy took hold among people with meaningful pension pots. Draw from your ISA first, use your savings, leave the pension untouched as long as possible, because when you died, the unspent pension passed outside your estate. It did not count for inheritance tax. Your children inherited it, free of the 40% charge that applied to everything else above the threshold. The strategy was sound. The advice was correct. Many families built their entire estate plan around it. From 6th April 2027, it stops working. Under changes confirmed in the October 2024 budget, most unused defined contribution pension pots, SIPs, personal pensions, workplace DC schemes, will from that date be brought inside your estate for inheritance tax purposes, at 40% added to everything else. The nil rate band remains at $325,000. It has not moved since 2009 and is now frozen until at least 2031. Add the residence nil rate band of $175,000 if you leave your home to children or grandchildren and you have a combined threshold of $500,000 per person, but that threshold has been frozen while house prices have not. Average values across this country have risen by more than 70% since 2009. More ordinary families are clearing the threshold today than at any point in this tax's history. And from April 2027, the pension pot quietly keeping them below the line gets added in. A man in his mid-60s, no surviving spouse, 1 adult child. His home is worth $390,000. A semi he bought in the 1980s. Savings and investments around $80,000. His SIP, $170,000. Today, his estate for inheritance tax purposes is $470,000. Home and savings. His nil rate band and residence nil rate band together are $500,000. No inheritance tax. His child inherits everything. From 6th April 2027, The CYPP is inside the estate. Total $640,000. Threshold still $500,000. Taxable $140,000. The bill $56,000. He has not moved house. He has not changed his investments. He has not done a single thing differently. The rules changed around him. The frustration I carry about this is not really about the policy. Reasonable people disagree about whether pension pots should pass free of inheritance tax. What bothers me is the gap, the distance between what the rules now say and what people still believe to be true. If you have a CIP or a defined contribution pot that you were planning to leave largely untouched, review your pension nomination form now. Check who you have named. The spousal exemption still applies. Pension benefits passed to a surviving spouse or civil partner remain outside the estate. Whether to restructure drawdown, how to rebalance between pension and other assets, how to use the time still available before April 2027. Those questions belong with a qualified financial planner who can see your whole picture. I am a retired accountant, sharing what I saw across a long career, not a regulated advisor, and your situation is your own. What this video can do is make absolutely certain you know the question exists before the window closes. Those two numbers from the beginning of this video, the state pension at $12,548 and the personal allowance at $12,700, sitting almost perfectly alongside each other. That is not a quirk or a coincidence. It is the shape of how retirement income works in this country. Every additional pound you generate beyond that point lands in taxable territory from essentially the first payment. The question is never whether HMRC gets involved. It is whether you have arranged things before work ends so that involvement is as small as it legally can be. The thread running through all 5 positions is the same thing: timing. None of these moves are complicated. None of them require specialist knowledge to understand. Every single one is simply cheaper, cleaner, and more effective to deal with before you stop earning than after. That window, the years when your income is still controllable, your ISA contributions still flowing, your gaps not yet filled by state pension and pension drawdown, is the most valuable planning resource most people in this situation will ever have. And most people do not know it is there until it has closed. So here is what I would ask you to do this week. 3 things, no more. First, open your general investment account if you have one, and look at what is actually inside it. Actively managed funds, income-bearing bonds or high-yield holdings, those are positions 1 and 3, and they can be moved. Second, look at the cost basis on anything you hold outside an ISA. If there are large embedded gains, you have a BED and ISA question worth thinking through before the CGT window narrows further. And third, this takes about 2 minutes. Find your pension nomination form and check who you have named. Given what is coming in April 2027, that piece of paper matters more right now than most people realize. If the gap years calculation or the inheritance tax side of things needs more work, a pension-wise appointment is free, government-backed, and designed for exactly this kind of conversation. I would genuinely encourage you to book one. And as I always say, I am a retired accountant, sharing what I observed over a long career, not a regulated advisor. So treat everything here as a starting point for that conversation rather than a substitute for it. The people who come through retirement with the most intact finances are rarely the ones who earned the most. They are the ones who understood a few years out that where their money sat mattered as much as how much there was, and who did something about it while they still could. You can be one of those people. Right, that is enough from me today. Thank you for watching, and take care.